Hey guys, Sean Bougie, SurplusFundsRiches.net. There will be a card that pops up, top of your screen. You can use that to go to our website and check us out. You can also, of course, like and follow the channel and get updates with more information like I'm about to give you. This video is going to be about the rise in mortgage rates and how everyone out there is talking about how the sky is falling. People are not going to be able to afford housing, and there's going to be a major adjustment to the real estate market. Well, I can't say this any other way. Sometimes you got to say things to really prove a point. I call bullshit. Okay, let me tell you why. First of all, the house, if I had bought a house, same time I bought my house recently, if I had bought a house for, let's say, $400,000, and I didn't pay that, and I'm not going to get into what I paid. I know there's guys out there saying, I've got a Rolex, follow me. Look at my rented Lamborghini in front of the pool at my buddy's house. Whatever, guys. 400 grand. That house, okay, March of 2020, would have run me $2,200 a month. Today, that's going to run $2,500 a month. Everybody's going to see $300. You've got to make closer to $700 more a month in order to cover that. So housing affordability is screwed. We're all going to see a massive adjustment. Yes, we're going to see an adjustment. Not in house prices. We're going to see an adjustment in the rate of increase. It's going to go from 15, 20 crazy percent down to a more reasonable 5%, okay, increase over this year. That doesn't impact us, at least not with the way we do it, at all. And let me tell you, first of all, I want to call BS on these guys saying the market's going to crash. Yes, we're in an inflationary period. Yes, the Fed is fighting that with rate increases. Yes, that's resulting in increased mortgage rates or mortgage interest rates. We're also seeing wages increase, and that's going to offset the majority of that. We're also seeing people getting smart and not spending as much, particularly in the middle class and upper middle class and upper class. Now listen, guys, disclaimer right up front, the guys in the lower class, lower income class, they're screwed. They've always been screwed. They're not going to be the buyers the majority of the time that we see. I'm just putting that out there. It's not I'm not making a judgment call on anybody. I'm just saying, if you're looking at a non-skilled or semi-skilled wage, yeah, those people are always going to be screwed. Always. Because they don't have a skill set, they don't have a professional license, they don't have something that's going to give them the opportunity to make more money, okay? Or they don't have education. Having said that, we're talking about on a $400,000 house, which is kind of normal for where I am in Charlotte, probably $350, $400. Let's say $400. A $300 increase doesn't mean jack. And let me explain why, okay? First of all, wages are going to erase at least half of that, the wage increase. I'm an employer. I know what's happened to wages, and I know what I'm paying my guys. Paying them more. I have to keep them because that's the market, okay? And the market adjusts if you leave it alone. The market adjusts by itself. And the adjustment is an increase in wages. That's going to erase at least half of that. The other thing people are not understanding is the middle class, upper middle class, and upper class over the pandemic were scared. And instead of taking a stimulus check and spending it the next day, okay, and I understand there were issues where people had to, but instead of doing that, they saved money. They saved it. They have money sitting there. Guys, the mortgage industry, more than anybody else, knows how to keep the party going. So what are they going to do as rates increase? They're going to push what they've been doing for years. I don't have an issue with the mortgage company, right? They're giving you hundreds of thousands of dollars to buy a property, and all you got to do is make your monthly, okay? That's a good deal. And there's a lot of competition, so that's a good deal. Sorry, that's my dog. Anyway, having said that, you can buy your rate down by almost a quarter point by putting a percent down. So a $40,000 house, you put $4,000 down, you're going to buy it down by almost a quarter point. You're going to erase a lot of that. You're going to see a lot more of that. The smart mortgage guys are going to push that. The smart realtors are going to push that. You've always got that option. And because the middle class, and upper class saved money over the last year, they've got it to spend. Okay? They've got it to spend. The other thing that is not getting factored in right now is we are becoming a decentralized economy. What I mean by that is I have people I know that do quite well for themselves, but they're freaking out and they're taking up secondary jobs. Not normal secondary jobs. They're being independent contractors. Your Uber Eats. I know people making $20,000, $30,000 net after their expenses extra a year by working weekends and a couple of nights a week. I'm not kidding you. I know that. And that is not factored in to the average wage. So they're not considering that when they're looking at what people make. The motivated people out there are making more money these days, not only in their wage, but they're taking up side hustles. They're doing the Uber Eats. They're becoming a researcher with us, researching overages, sending them in. We put the deal together. Good Lord, we can pay on average with certain programs over $8,000 a deal. Same thing with our flips. We can pay 30%. Deed flip 30, we pay about $9,000 per deal because we make about 30 grand per deal. So you got to understand that people are making more money, not just on paper, but as independent contractors. Okay. Also, it's not a huge hit. It maybe went from $2,200 a month to $2,500 a month. All right. The other factors to consider here are everybody's going, oh my God, the stock market's going nuts. It's so crazy. 2 years ago, the average was around 30,000, the Dow Jones. Now it's 36. That's a 20% increase. So what we also have is the wealth effect going on. Okay. The wealth effect, even though it's on paper, is people that do have 401ks and IRAs are looking at it. Okay. They've got an index stock portfolio. They're looking at it going, I'm doing great. So that imparts a sense of, you get a little cocky when you see that, right? So we've got the wealth effect. Also, the driver in this, the buyers out there that are buying real estate right now are the 30-somethings. These are people that are getting married and they want the American dream, just like their parents had. So white picket fence, dog, couple of kids, the whole nine, right? These guys are pushing that, and guess what? They are not risk averse. They are very risk tolerant, and they're pushing it hard. And a lot of times, it's a young couple, both of them professionals, educated, making a heck of a lot of money. This isn't impacting them. Finally, we go after low-hanging fruit. We're getting stuff before it goes to, with two things we do. We go after property prior to a tax or mortgage foreclosure, get it super cheap, resell it cash, so interest rates don't affect us at all, to an investor without fixing it up, and let them fix it up and also make a heck of a lot of money on their end. Our average buy is 30 grand and our average sell is 60. Our average net, and when I say that, yes, I understand that there were costs involved with this, but our average net is right around $30,000. Okay? And I sell them in a week or two because I'm selling as is, where is to investors who have cash. Guess what? They don't care about the rate. They don't care. They don't care about the rate. They have cash. So that's a big deal. We also go after surplus funds, which is money left after when somebody buys a home at foreclosure and it sells for more money than the bank is owed or whoever's foreclosing. That extra money, if there was an additional debt, is owed to the ex-owner. And we capitalize on that, make a deal with them and get it out. And we'll partner with you guys on that and on flipping property. But the bottom line is we're recession-proof with that, right? Because even at a 5% increase, stuff is going to continue to sell for higher and higher money at the auctions. People are chasing it because rents are also going up. Final point. Rents are going up, and they're going up as fast, if not faster, than what the mortgage payment would be. So what is the difference here? So these guys that are screaming out there, the sky is falling, we're effed. You don't know what you're talking about. You are looking at just the rate and the monthly payment. You're not considering the wage increase, and I'm going to get to inflation in a second. You're not considering the wage increase, the decentralized market that we're in now, decentralized economy that we're in now, the fact that these guys are really risk tolerant, the drivers to this market right now are really risk tolerant, you're not considering any of that. You're also not considering the difference really isn't a big deal. Now, everybody's going to yell at me and go, Sean, what about gas prices are increasing, food prices are increasing. The inflation affects us at a number of different levels. You're absolutely right. First of all, you're going to see guys getting rid of discretionary spending. If it's a matter of going out to eat versus cooking, they're going to get rid of that. The smart guys are going to be brown bagging. They're not going to care what people at the office think. They're going to go out. They're going to bring in a sandwich, okay, and some vegetables, and call it good. All right, that they're going to cut back on. Understand that. They're going to start taking single trips to run errands, save on gas. They're going to be doing a lot of things differently. They're going to be doing a lot of the work themselves that they may have hired out in the past if they can pull it off by watching a YouTube video. So I'm not trying to marginalize or minimize the impact of inflation here. I'm just telling you that the inflation rate, scary as it sounds when you look at the numbers, are not going to impact these guys as much as you think. We're going to see a 5% year-over-year increase in houses by the end of the year. It's that simple. And our business, the way we do it, flipping property pre-tax and mortgage foreclosure, and working with guys that got an overage as a result of the house selling for more, we're going to continue to rock it out. Those of you guys that are with me, I've always been right about this. I've always been the one that I don't do clickbait. I don't go, oh my God, Armageddon. I don't do that. We're in a much better position than people think. Don't get freaked out when you look at the news when they're only considering one portion of the market and they're not looking at the entire global impact of what's going on. SurplusFundsRiches.net.